if someone's about to do a Chapter 11 or a reorganization from a bankruptcy perspective, that's probably not a good financial client. In a group captive, all the members or all the business owners are owners within that captive.
You need to understand claims. You need to understand reserving practices, and you need to understand what the carrier really needs in order to be able to release collateral, because that's also protecting them.
Everybody has to pay a premium. And so no matter what kind of program you're in, a portion of the premium you're paying goes toward prepaying for losses.
If you're listening to this and you're thinking about the people who you would want to put into a captive, I want to be very, very clear about a couple of things. Number one, they have to have good financial health. They have to be able to get a letter of credit or have enough liquidity on their balance sheet that they can fund with cash.
The reason we're so rapidly accelerated when we actually pay back is because we do a tiered distribution. We distribute 40% the first year, 30 the second, 30 the third. So if you're in year 3, you're getting 40% of year 3, probably 30% of 2, and 30% of 3. You've got a ton of money coming to you. So it's plus the interest.
Financial strength is so important, is not just because they need to qualify for a letter of credit once. I mean, you're going to collateralize, and your captive may be set up different, but in my experience with high deductible programs, you got to collateralize year 2, you have to collateralize year 3, because those are all years where you're going to have more losses. And if you're pre-funding them through the claims fund you're establishing, you have to be able to put the money in to make that work.
For us, the retention level is the level at which a loss is going to be picked up with inside the captive. And for us, it's actually adjustable based on size of the company, the types of losses, and the risk profile. And anywhere from $50,000 first level retention up to $250,000.
What's up, everybody? Welcome to the Power Producers Podcast, where we are refining and redefining the sales game. And the way we're going to do that today is we're going to talk about captives. This is a subject that's come up over and over and over again the last couple of years. And as the market continues to harden, the number of times we hear about it increases. Our guest today is Jason Duby with Granite Captive. He is a captive manager for Granite, and his responsibilities are agency and brokerage development. So he's here to educate us on what they do, why they do it, and how they could help you and your clients. So with that being said, what's up, man?
Hey, Dave, how are you?
I'm good. I'm good. So before we get too cranked up, why don't you give everybody a little bit of your backstory and tell them who you are, how you got to where you are, and what you're doing now?
Sure. Well, I've been in sales probably my entire career, but I was in production as a producer in the small commercial space, and in the mid-market producer space for quite a number of years before coming to Garnet Captive. And we're here as a what we call a USA domiciled group captive. Look, bottom line is there's three definites in life, right? Death, taxes, and premiums, and you can't get away from all of them. And so we might as well take advantage of having to pay insurance premiums, and we're going to kind of maybe show you a little bit about how we do that.
Sure, absolutely. So captive is a very broad term. And the more people I talk to, the more I realize that there's completely different segments inside of the captive industry, if there's such a thing as the captive industry. Talk a little bit about what your captive does, how it's set up, and what makes it different from maybe some of the other options that producers have seen out there to date.
Yeah, for sure. So we're a group captive insurance company. So basically you have a handful of businesses, some same industry, some mixed industry, formulating basically an insurance company to take advantage of those pre-funding losses. So there's businesses out there that don't file losses. We work to make it efficient to get back that premium dollars plus interest at the end of a policy term. What sets us apart from others in the group is a couple of things. First and foremost, we have an accelerated distribution schedule of basically a year after policy expiration. Most others, in the same space, the typical A fund, B fund model, you're looking at getting your money back after 4 to 5, maybe in some cases 7 years after. It takes a while. So we're a lot shorter in that regard. We have some reduced upfront costs to get in. We have a very, I would say, creative shared loss model that kind of helps insulate the member as well as the rest of the group. And a great amount of flexibility goes in, right down to even retentions in line of business.
Okay, so our job today is we're going to educate all of the people that are out there listening to this on how a captive works. And we can use yours as the example because a lot of these people hear it, they use the term, and they think they may even hear it from their clients and prospects saying, well, I haven't had losses in a long time. I'm paying a ton of money. I ought to just go into a captive. And that's the extent of which they know. So I've taken about 15 questions from your first 30 seconds that we're going to spend some time on here over the next little bit. And I think the first thing that's important is, explain what make the difference between a group captive and the other versions of captives that are out there. Maybe even we identify, the different types of captives that are available, and then explain what makes a group captive different.
Yeah, I think that makes sense. So there's a single parent captive, which is really one business and one insurance company. They're really large, and a lot of different things can be in that captive, not just the lines of insurance that we think of. Our captives, most captives, pretty much are general liability, work comp, and auto for lines of coverage. So that's basically the first thing: single parent versus group. A group is just a bunch of businesses, basically, some same industry, some different, who've gotten together to form that company. And then there are other captives out there, like there's property captives out there, for example. There's just captives out there that focus on particular industries like transportation, like uh, construction, and so forth. And those are typically roofers. Those are homogeneous captives, just one industry. Um, and
Yeah,
then,
there's also protected cell captives is another one, and it's something that we've seen specifically with one of the carriers that we represent here at the firm, where you have a very limited is the agency a very limited financial exposure and a reasonable contribution to get in on the front end and buy capacity. And so we see that a lot because it's an easy way for an agency to take the accounts that they have field underwritten that appear to have a good risk profile that would fit that model and increase the profitability of the agency itself by being able to put that business in a separate area than what they would put into the general underwriting bucket. So that's probably a pretty good overview. The next thing that you said was, you talked about having an accelerated distribution model. But before we get into the accelerated distributions, let's talk about what it actually takes to set something like this up and what type of out-of-pocket expenses and what are the things that those cover when somebody decides, I think I want to, create a captive or go into a captive. And before we do that, the thing that I'm picking up on is what you do is something that's probably a good agency or even a wholesaler decision if they've got a subset of business that's clean, that they think will continue to run clean. And this isn't necessarily you're going out to your client and trying to put them into a captive. This is more you're going to create a captive inside of your agency or your brokerage and cherry pick your best clients and put them in there to enhance the financials of the agency itself. Is that accurate?
sort of. I mean, we do have that ability, and we would do it in much the same way you just discovered it or discussed rather, that we could potentially create an incubator cell. But because
Well, the reason, let me ask you this, because then maybe I'm confused. Because how do you get a bunch of different businesses that don't have anything to do with each other to decide they want to go the captive route, unless it's something that's in your book of business and you're the one that's populating it?
yes,
That may be where the disconnect is for me.
yeah, no, I see what you're saying. So there, in the world of captives, there is the homogeneous group, which is pretty much what you described initially, in that they're all of the same industry, all either landscapers or they're security firms or they're, you name it. And then there is the mixed group, and in the mixed group, what you really got to consider is the vetting process of getting in to that captives. Yeah, sure. In most of our groups, we have a mix of industry, and it's basically a mix though of what you would describe best in class, clean running, similar type of risks in terms of profile. Like they're clean, they don't have a lot of frequency going on, and so it's more that than Hey, and what it does is it allows us to say, okay, we're looking at a huge segment, and broker X might come to us and be like, you know what, we have a lot in the way of egg manufacturer or egg distributors, and we have a lot of them. We have a handful of these guys on the books, and we really want to do our own egg distributor captive. We've done business with you. We know that you're very solid. You know what you're talking about, and so we're gonna probably start an incubator cell in our main captive. And once it gets to critical mass, we can move that to a broker controlled captive, that's why I said it's sort of what you had talked about, but very similar.
So in your situation, who actually owns the captive? Does Granite own it, or do the people collectively own it that go in, or does the agency or brokerage own it if they're the ones who want to start it?
Yeah, no. So, who would own the captive? It's the members. So each member, there's a share purchase requirement, or you're all sort of owning part of it. So in a group captive, all the members or all the business owners are owners within that captive.
Got it. Okay. So we decide we're going to start a captive, and we can run with egg distributors. That's a class of business I'm very familiar with and have written plenty, and some really nice sized ones. And they certainly, if they have their risk management things in place, they can be very profitable as well. We decide we want to start them. What's the first step that we have to take?
Basically, underwriting to make sure it's gonna make sure they're clean, make sure they have a risk profile or a risk appetite or an appetite for risk control in the system or in their system as a business, that the premium makes some sense, and that they themselves are in for the long haul in terms of, we know that it's not a dollar for dollar premium savings right up front. We know we're in the savings for the long haul, and that we want to sort of control rate and safety and claims and all that.
Okay, so we get past underwriting. What's next? What's my financial commitment? How is that determined, and how do I pay it?
Sure. And you're talking from the perspective of the captive business owner, correct?
Sure.
Yeah. So the financial, so there's always an element of collateral. So um in order to make the program work, everybody has to post some sort of collateral just on the off chance they go, insolvent or walk away. That collateral, depending on the program you're in, is either 25 or 30% of premium. We take a rolling average. It's a 2-year rolling average over 3 years. So after the third year, you're fully collateralized. So that's a consideration of either cash or letter of credit. That's one of the first considerations. Just like your standard market guaranteed cost program, you have the ability to do a 10 pay option. So there is your certain percentage down. So there's a down payment that you would have to consider. And for us, that's it. And some of your typical A fund, B fund captives out there, you have what's called a share purchase of like 36,000 or $40,000 that they have to put up front. So we've eliminated that. And so for us, what you're considering to enter that captive is your collateral and your cash down payment.
Okay, so you've referred to it a couple of times, and I'm fairly certain a lot of people that are listening to this aren't familiar with what an A fund, B fund captive is. So, you got to remember, man, you got to dial this back, and we're going to build them up, because the people who are listening to this podcast have the clients and the people that you might want in a captive, but they're not captive people. So we got to build the foundation so that they're speaking our language. Otherwise, everything we say sounds like Spanish to them. So,
Sure.
from that perspective, maybe give them a cursory overview of an A fund, B fund captive, and then maybe tie that back quickly as to what makes that different from what Granite does.
Yeah, sure. So let me just roll this right back. So first and foremost, like I said up front, everybody has to pay a premium. And so no matter what kind of program you're in, a portion of the premium you're paying goes toward prepaying for losses. It absolutely does. And I think the math works out depending on the carrier. 40% is carrier expenses, 60% is program. That's what the old adage used to be, even though that's not quite the math for us. But a portion prepays for losses. So if you're the type of business who's constantly having losses, and at the end of the year, the carrier looks at you and be like, okay, Mr. Business Owner, you had a lot of losses, and we're either going to raise your rates because of those losses, or we're going to non-renew you. Fine. But what if you're that business owner, though, who has really good losses? You don't like to put in claims. You don't pay them because you're on top of your stuff. What happens to all that extra money? The carrier keeps it. You become profitable. They fund a golf tournament. So very simply, the group captive tries to get that premium that you're setting aside that you're not using and get that money back and give it to you, as well as pay you interest on top of it. And that is the very simplest form of what a group captive does. Now, that money that they set aside can go into two different buckets. A bucket that pays for frequency, which in a lot of cases is called the A fund. With us, we call it the primary fund. And then they put it in a shared layer because you share losses with everybody else in the group. And that, in some cases, is the B fund. With us, it's the large loss fund.
Got it. And honestly, everything you're describing is exactly how an insurance company functions. It's just a matter of taking it out of the carrier's hands and putting more control in the hands of the business owners and the people who own the captive. So when you talk about accelerated distribution, I think that people might or might not understand what you're even talking about there. My assumption is you're talking about how quickly capital can be returned and how quickly underwriting profits can be, or collateral return and how quickly underwriting profits can be shared. And, you have to take time and let losses develop. If we've been through CIC and CRM, we understand loss development factors. We understand incurred but not reported and all of the other things that factor into, workers' compensation. But the reality is, and this is also true with a lot of high deductible insurance programs, collateral can really hurt a company if they don't handle things the right way. Number one. Number two, if you're listening to this and you're thinking about the people who you would want to put into a captive, I want to be very, very clear about a couple of things. Number one, they have to have good financial health. They have to be able to get a letter of credit or have enough liquidity on their balance sheet that they can fund with cash. You can stop there, or that could be the second question and make the first question the next one, which is, how good are they in terms of their loss history and their risk profile? I think that there's a common fallacy that if somebody's got really crappy losses and they're getting non-renewed by a carrier, the solution is, oh, well, we'll just put them into a captive. That's the absolute worst thing you could do because they've not proven they can manage risk inside of a guaranteed cost program that actually has structure. How in the world are they going to do it if you put them into a place where, it's not the same, right? Not that you don't manage risk, not that there's not structure. It's just a completely different animal because they have a ton of skin in the game at that point. It's a whole different ball game when you're playing with somebody else's money versus playing with your own. And in my experience, to your point earlier, when you collateralize a program, most of the time before you start getting that collateral released, you're looking at 3 or 4 years out from when you originally posted it. We ran into this at my prior firm where we wrote the master workers' comp policies for PEOs because many of them had $1 million deductibles. And guess what? We didn't even get to determine the loss pick. We could have calculated it, but it didn't matter. You were told what the loss pick was going to be, and you could take it or leave it based on what the carrier said. But then not only do they figure out what your projected losses are, but they calculate the collateral that you're going to have to put up based on what they think your projected losses are. And to your point, I've seen collateralization on high deductible programs where the carrier expected 150% of the projected losses just as collateral. And you're saying it's a fraction of that in the group captive model that Granite administers. And so when people put that money in, I think it's really important for producers that are listening to this to understand the reason financial strength is so important is not just because they need to qualify for a letter of credit once. I mean, you're going to collateralize and your captive may be set up different, but in my experience with high deductible programs, you got to collateralize year 2. You have to collateralize year 3 because those are all years where you're going to have more losses. And if you're pre-funding them through the claims fund you're establishing, you have to be able to put the money in to make that work. So companies that don't have financial strength are likely not going to, they may qualify year one, but it's possible that, they're too thin on margin to qualify in years 2 and 3. So it has to be the best clients you have, both from a loss experience standpoint, but also in their financial strength.
Yeah, absolutely. I mean, you hit everything pretty much spot on ahead. Also, to that end, I mean, if you're looking to sort of profile what these clients look like from a mindset perspective, if your client is the type to say, "Hey, let's get quotes every single year and let's go out to market year after year," not the fit, because this is a long-term play and it's you're in it. And to that end, being that it's a long-term play, it's also a good tool for the producers on the podcast here to strengthen their book of business. It's a little more sticky because of the long-term play factor. But that's one of the key factors that I look at. If someone's telling me, "Hey, we're going to sell off in 2 years, or every 3 years we sell," it's the conversation is along the lines of it's probably not going to be a good fit for you.
Yeah, and I think there's probably a lot of questions or a lot of things that producers should be listening to when they're out on the streets to kind of cue them as to, hey, this is a good opportunity or this is a not so good opportunity. And the other thing is, if you've got somebody who's in a captive and they say they want to come out, to me, that's a red flag. Okay.
Yeah.
Like, I would think it's a major red flag because there's really, to my knowledge, I can't think of a single scenario where there's a better financial opportunity for them outside of a captive than inside, unless they've got really bad losses or whatever else. But the other thing is, let's just say you think you found one. You need to understand how the collateral in these things work, because a lot of times, I'm speaking again, I'm going to be interested in your thoughts on this. I'm speaking from the high deductible world and the paid loss retro world, as opposed to, captives in general. But there's a lot of times where somebody gets in and they end up not being able to afford it based on a downturn in business or whatever else. So they want to come out and they think that you can help them, and you come in and you give them all of these solutions that maybe is going to be a little less attractive than the captive, but maybe the buy-in for the program's more, but there's no collateralization requirement. You need to make sure you understand what you promised them, because just because they leave the captive doesn't mean they get that collateral back. They're still going to have to wait until
Yeah.
it's released. And I can tell you, just having dealt with this in high deductible stuff before, that's part of the negotiation process. You need to be able to go in and you need to understand claims. You need to understand reserving practices, and you need to understand what the carrier really needs in order to be able to release collateral, because that's also protecting them. So there's a lot of moving pieces to this stuff, and it's one of the reasons why I'm a big believer in, if you don't do it and you're not an expert in it, find the person who is and use them, because there's too many traps that you can get caught in as a producer, thinking you're doing something for your client because they heard a buddy at a trade show talk about the captive they're in or whatever else, and they put pressure on you, when you might be giving bad advice thinking you're doing the right thing for your client and saving an account, when in reality you're just making things worse.
I mean, and you're absolutely right about that, which is why I think in our world we scrutinize, as a captive organization, the accounts that we're letting in, and I'm sure a lot of the producers do as well. And you mentioned the collateral situation. I mean, you're right. That doesn't just come back to you. So what we try to do is educate the members, particularly on IBNR and what the loss reserving and what that all looks like, especially on their annual statements, because they all have to be aware of, hey, this is what I'm getting back or what I'm not getting back or what could potentially happen, and they want to know, why is it different now? Why am I getting less than I thought? Well, that claim that you had just skyrocketed because he had to go through rehab. So you're right about that. There's a lot of considerations for sure, and you got to make sure people fit the mold in many different directions.
And so to me, there's three main financial components when you're in this type of relationship. There's the And I say financial components. I should probably say considerations. Components sounds like it's building it, and I'm really talking about considerations. The first one's the collateral, second one's the premium, and then the third one is the distributions, which that speaks to how profitable was the captive, and as a result, how much of that money am I going to get back is one of the captive owners in the form of a distribution, right? And so you know, not only are you worried about how long collateral is going to be locked up, you're going to be worried about how the captive's performing and how much your premium is going to remain stable, but you also kind of want to know, how are we managing this thing, and when am I going to start getting my, as Mr. Wonderful on Shark Tank would say, when am I going to start getting my beak wet a little bit with some of the distributions based on profitability?
Yeah, I mean, you're going to want to know all that. You're going to want to know when I'm getting my money back. You're going to want to know how the other members are performing. I mean, let's be real. We're sharing loss with everybody else in a group. You're sharing profit to a certain extent. So you're going to really want to make sure that you're in a program that performs well. If it's something where they say, "Hey, we just barely started this thing 6 months ago," you might want to search for another program, and at least until it gets a little bit of maturity on it.
Yeah, so that brings up an interesting question. What happens when it's time to vote somebody off the island? Who makes that decision? Is it the group members that collectively own the captive and they decide, you know what, Joey? You're not cutting the mustard anymore, man. I'm sorry, but we're going to invite you to leave because you're costing all of us money and financial opportunity because you're not taking things seriously, or you've had a stroke of bad luck, or whatever it is. Or is it the captive, or is it a combination of the two?
I'll go on record as saying this hasn't really happened a lot, if at all, at least since I can remember. But it's the latter. It's the captive. It's the board. It's not just one guy up there
Well,
making
I
the
guess let me
decision.
let me frame the question a different way. Is it the group that collectively owns the captive, or is it actually Granite or whoever would sit in Granite's seat that says, "Hey, this guy's got to go," or is it a collection of the two of them having that conversation?
Yeah, it's a collection of the two of them having a conversation.
Okay.
Garnet, by the way, not Granite. I think I
Garnet,
tied it with
garnet,
some.
garnet. I
Yeah,
told you, man. I'm gonna say it too many enough times. I'm gonna get it wrong once.
they're both a stone, so it really really good. But yeah,
One
no,
makes one's a ring and one's countertops. They're very different stones. I get it.
yeah, for sure. But they're both deadly in their own right. But yeah, no, it's a combination. I mean, each group has a board of like 7 members, and then 5 of them are, of the of the businesses and the other 2 are sort of in-house kind of like uh, Garnet people. So it's a combination of two. It's the board, and it can't just be one because we all sort of have to agree on it, and it has to make sense.
Got it. So we get in, we're in the captive for a year, 2 years, going on 3 years. This is a point where we can start to maybe look forward to getting a little bit of relief on the collateral side and having. You're always going to probably have what, 3 or 4 years of rolling collateral, but you're going to quit stacking it on top of each other, right?
Yeah,
Because at
you're
some
right
point,
about that. It's so for us, it's 2 years rolling collateral at either 25 or 30% of premium, and it's financed over 3 years or stacked over 3 years. And after the third year, if nothing changes, then it doesn't keep stacking. I mean, you got to sort of run financials. Should somebody have a banging year or a bad year, then you might have to put in a little bit more. But in theory, after year 3, it doesn't keep stacking, you're good to go, which actually just lowers your cost to maintain it, quite a bit.
and then as far as distributions go, you start getting in 3 years, you can think, okay, maybe going into next year, or within the next two, we're going to start being able to realize some of the profits that the captives made.
Yeah, quite a bit because we do it. The reason we're so rapidly accelerated when we actually pay back is because we do a tiered distribution. We distribute 40% the first year, 30 the second, 30 the third. So if you're in year 3, you're getting 40% of year 3, probably 30% of 2, and 30% of 3. You've got a ton of money coming to you. So it's plus the interest. So it's definitely, I would say, compounding and impactful for sure in that regard.
Yeah, and the other thing is, excuse my phone. The other thing is, I think people sometimes, when they're looking at this, they have to understand that the risk management and the proactive risk control and all of that is extremely important. But then also, how claims are handled inside of a captive is really important. And I'm not exactly sure of your model, so maybe talk about that for a second. But um, what does that look like? Are you using a TPA? Is that stuff done in-house? How's that go?
Yeah, no, absolutely. So we are using a TPA. And on top of using the TPA, we have an in-house Garnet employee who sort of like streamlines and helps guide in the right direction the use of that TPA. Beyond all that, when we bring somebody on board to bring them on, we're setting up with them exactly what they need for risk management right off the bat. We don't want to, we have to customize a program. Not everybody's the same. So what level do they want to be involved with? When do they want to be notified? Um, do you want to be involved from everything from the word go? So we really try to customize how those claims are handled and managed. So that's where really a lot of the control comes in.
Got it. So if I'm a producer, what am I listening for out on the streets? How am I going to determine this makes sense, to have the next conversation? What are the things that I would hear coming out of a client's mouth or whatever else that would make sense?
Yeah, so one of the things is premium size. If you have somebody who's constantly they're really good losses and they can't figure out why every single year they're getting increase after increase, but they're not the type to pay a lot out in claims, that might really matter. That might be a really good indicator. Company revenue, they're growing. They're now expanding. They've got, 200 people out there in the field. That's a good, a good size. Maybe they're an industry that's safety. You're checking, what's the culture look like? That they're posting a lot of charitable work, but not only that, they're talking about their culture of safety and how they value employee well-being. That's another indicator that they're probably safety minded. Um, Running OSHA reports. If you're just doing your research and somebody has a ton of OSHA reports and activity out there, they're probably not a good fit. There's just as many of those indicators. Jumping on Safer and saying, wow, what's the cab report look like? If they're a transportation company and they're getting dung and they're a red because they're 95% bad on maintenance, well, then they're probably not going to be of that safety model. Company revenue. If you go to check out the revenue maybe on Google or something, and it's saying they're a $2 million company, might be a little smaller than you'd want to consider for a captive. Fleet size. You ran Safer and it said, wow, they got 50 power units. That might be a good start.
What are my red flags? What do I not want to hear?
You probably don't want to hear everybody else turn me down and I'm going to come to you guys because we need to be in a captive. You don't want to hear that. You don't want to hear, well, my mod's a 1.75, but we're working on it. Experience mod, the work comp rating, by the way. You don't want to hear about them getting fine after fine because maybe people are falling off of ladders. You probably want to avoid these public lawsuits if you see them all the time. Hey, such and such is being sued again, for safety and harassment and so forth. If someone's about to do a Chapter 11 or a reorganization from a bankruptcy perspective, that's probably not a good financial client. Um, yeah. And if they're manufacturing dynamite, you probably won't get them into a captive.
Yeah, no, I mean that so you've kind of run the gamut a little bit. I think that's another thing worth talking about just for a second. I mean, obviously dynamite manufacturers probably not great for a captive, but you talked about transportation being one that might be good, and a lot of people fear transportation because of the nature of it and the potential for shock loss. So, I mean, are there any industries out there that you say, you know what, absolutely not? This doesn't make sense. And, otherwise, is it fair game? We're going to look at each company as on its own as a standalone basis and see how they've managed it in the past, and we'll make an educated decision once we've had a chance to dive in and do that.
Yeah, I mean, in large part, that's our motto. It's look, if it makes sense, we can probably make it work. But there are definitely some industries, honestly, that we would run the other way from. For example, roofers and framers. We're not a market for that, and it's not because that's a bad industry. It's because there's other captives out there that really love that stuff, and they probably do it better. From a transportation perspective, we're not a huge fan of long haul, hazardous waste, or moving mass quantities of people. But ambulance, for example. But for to that point, there's other programs out there. But essentially, I like using the adage, if it doesn't blow up, fly, or go bang bang, we're probably going to be okay with it. And the great thing, at least about us, is, there's three lines we're looking at: general liability, comp, and auto. And there's a lot of times submissions or just businesses come my way, and we can say, you know what, the general liability, for one reason or another, doesn't really fit the mold, but the work comp and the auto would. And so we look to really, again, try to find a home for a risk if it makes sense for the group and for the business.
Yeah, no, all good. We've been going for a little while, man. What have we missed?
Maybe how we share, because there's shared layers in captives, and then your typical captives, the way that we share, I think, sort of stands out, and I think is pretty impressive. But I am a captive guy, so the rest of the world might not find it as impressive as I do. Um, but we have a pro rata shared model. So that means we have our shock loss layer or a large loss layer, large loss fund, and everybody chips in money into that fund. There's millions of dollars going in there, and everybody who is a member of the group is a certain percentage of that fund. So everybody is on average 1 to 2%. And that's the portion of that fund that they share. So you could have a $200,000 loss that would hit, and you're only going to pay, instead of 200,000, 1 or 2% of that. That's extremely different than the way the rest of the captive world works. Because the rest of the captive world, usually you have to expel your shared layer before you share with anybody else in terms of how you fund it. We really value the safety and well-being of the group and the member, and we don't want to see one large loss implode a program or a particular member. And so that is just a big difference about how we operate. Um, I don't know if we want to talk about that, because one other big difference is our retention levels. For us, the retention level is the level at which a loss is going to be picked up with inside the captive. And for us, it's actually adjustable based on size of the company, the types of losses, and the risk profile. And anywhere from $50,000 first level retention up to 250.
Got it. So if I've got producers that are ready to rock and roll, they think they've got a great company that would fit into this model, where do they reach out to you? Where do they learn more about Garnet specifically?
Well, you could reach out to me via my email at Duby, Duby, at garnetcaptive.com. So GARNET captive.com, or Google Garnet Captive and go to the website. Or you can give me a call directly on a cell at 802-345-8571. And that's how you would start the process. Just give me a call or an email, and I'll gladly talk with you. If it's something that's a quick no, we're going to get to that no as quick as we can, so you can move on and find another home for it. But I'm here, I'm responsive, and I'm taking, meetings with anybody who needs to meet and work on things.
Good deal, man. Sounds good. I think we've given them a lot to chew on. Anything you want to bring up before we wrap up?
Yeah, look, I mean, if you're out there looking for a partner who's responsive and wants to kind of help you work through certain situations, give me a call. I've been in the producer shoes for a number of years. I know exactly what you're going through, and I know what I didn't like. And what I didn't like was somebody being non-responsive and not helping me out when I needed it. So you're never going to get that from me. Call or an email, and I'm all yours.
Sounds good, man. Well, listen, I really appreciate you taking time out of your schedule to do this today. We're going to throw it out there because I know there's a lot of producers that are searching right now. So hopefully it'll bear fruit for both you and them. This has been a really good conversation. We've been able to give everybody kind of a good overview and a general understanding, and maybe a little bit more about how this stuff works. And that's what we're attempting to do every time we record an episode, is make people better after listening than they were before they started. So thanks again to you, and I hope you have a great weekend, man.
Yeah, you as well. Let me know if you want to do it again sometime, David. This was incredibly fun.
All right, brother. Take care, man. See ya.
You got it.